In the Caribbean, owning a home is not simply a financial decision. More often than not, home ownership takes on an emotional overtone, which oftentimes affect the decision-making process. But what happens when the dream of home ownership becomes a 30-year financial obligation and no one took the time to explain the fine print to you? In this week's podcast, we highlight 8 key items that prospective homeowners need to understand before committing to what is perhaps going to be the single largest investment in their lifetime, the purchase and financing of their dream home. The first point to note, and this is perhaps the most obvious, is that almost without exception, most mortgage loans are at a variable rate of interest. What does this mean? It means that the rates are likely to increase over the life of the mortgage, which invariably means that the monthly installment is also likely to increase over the life of the mortgage. Perhaps even more importantly is the fact that these increases or changes in the interest rates are in the absolute discretion of the bank. The second point to note is this. While most borrowers are principally focused on the interest rate that they will be paying and the down payment which will be required, there are other significant fees and ancillary costs associated with mortgage financing which should never be overlooked. Among some of the key fees that first-time homeowners underestimate are commitment fees to the bank, which are typically 0.5% of the loan amount, valuation fees on the property being purchased, which are typically 25 basis points or 0.25%, stamp duty and transfer fees, which increase progressively depending on the size of the mortgage. These can range from between 3% and 7%, depending on the jurisdiction in which the transaction taking place. There are also legal fees to be paid to the attorneys, and there's also mortgage insurance fees. The key point to take away here is this, that prospective homeowners need to count the cost. If you cannot afford the upfront fees and costs comfortably, maybe you are not ready to take on a mortgage at this point. Another key aspect of a mortgage loan, which is often overlooked by the borrower, is the presence of what is called prepayment penalty clauses in the loan agreements. Many mortgage loans have what is called prepayment penalty clauses. A prepayment penalty is simply an amount that the borrower would be required to pay in the event that they chose to repay the loan prior to the stipulated expiration date on the loan. These prepayment penalties are typically imposed because banks are funding their mortgages using match funding and interest rate assumptions, and the early repayment by the borrower disrupts expected interest income and creates reinvestment risk for the bank, especially in an environment when interest rates may be falling. Prepayment penalties on mortgages in the Caribbean often range from 2 to 3.5% of the outstanding balance of the loan at the time that the loan is being repaid. Another point often underestimated and misunderstood by prospective borrowers is the total amount they actually pay over the life of the mortgage. On a typical 30-year mortgage, with interest rates ranging between 7.5% to 10%, the borrower will repay the bank approximately 3 times the amount initially borrowed. Let me repeat that. On a typical 30-year mortgage, the borrower will repay to the bank approximately 3 times the amount initially borrowed. As an example, a borrower taking out a 30-year mortgage for $1.5 million at 8% would repay to the bank $4.15 million over the life of that loan. This would include an amount equivalent to $2.65 million in interest. Another aspect of mortgage loans which most borrowers are totally oblivious of is the fact that banks are allowed to sell or assign their mortgages to third parties. Most mortgage agreements include an express assignment clause, which typically stipulate that the bank may, at any time, assign, transfer, or novate all or any of its rights in the loan and mortgage. And this is the interesting and important point to note, that the bank can do this without the consent of the borrower. Whenever the loan is sold in this manner, the new owner steps into the bank's shoes and is entitled to collect payments and enforce the mortgage just as the bank would have. From the borrower's perspective, their original obligations, however, do not change. An aspect of mortgage loans which sometimes causes confusion is the fact that most mortgages issued by banks are typically structured as demand mortgages. What does this mean? In a literal sense, it means that even though the loan may have been initially negotiated as a 30-year loan, the bank could require the borrower to repay the loan immediately or over a shorter period of time. However, although these loans are legally and technically payable on demand, Caribbean courts over the years have interpreted demand mortgages commercially and reasonably, meaning that banks will not be allowed to demand immediate payment if a customer is servicing their loan and is not in default. While there is no statute or law requiring borrowers to take out a life insurance policy to support their mortgage loans, some banks, however, insist that their clients do. The purpose should be obvious and it is quite simple. In the event that the borrower dies, the outstanding mortgage balance can be repaid from the proceeds of the life insurance policy. In the process, and in this way, the bank actually protects the estate and its family from potential foreclosure. While this practice is prudent and in many respects advantageous to the borrower, it is always advisable that the borrower negotiates a declining cover policy. That is to say, one in which the insurance premium declines as the loan balance declines. The final point which I would like to highlight is this. Unless borrowers specifically request of the bank that they release or discharge their security over the titles of the property which they use to grant the mortgage loan, the bank oftentimes would continue to keep the charge in place. This is sometimes done to spare the borrower the expense of releasing the charge and then having to put another charge in place in the event that the borrower may want to approach the bank for a home equity loan or some other form of loan at some other point in time in the future. Consequently, unless the borrower specifically requests that the bank releases the mortgage, you may find that years after your loan has been repaid, the bank continues to hold a charge over your property. So let's see how we can wrap this up and tie it all together. A mortgage is perhaps the most significant investment that a person will make during their lifetime. The decision of owning a home is often highly emotive as it speaks directly to status and legacy issues. However, a mortgage is a double-edged sword. On the one hand, it can build long-term financial security, but on the other hand, it can create long-term financial pressure. The key here is this: having a full and clear appreciation of what you are really getting into from the very outset. When borrowers understand the full cost, the risk, and the realities of homeownership, a mortgage can be a tool which creates generational wealth and not a financial trap, as it often proves to be. The goal should never be to simply own a home, but more importantly, to enjoy it. Something to think about. A word to the wise.